Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Natoyah Grinnon. She is a visionary leader and a CEO of Apex Global Properties, where she specializes in mortgage notes, tax liens, and tax deeds. With a passion for improving financial well-being, Natoyah is dedicated to providing long-term strategies and accessible investments for her clients. Natoyah, welcome to The Wealth Flow.
Thank you, Keith. Thanks for having me.
Yeah, I'm looking forward to this. I typically like to start with kind of your background. So where you grew up and what eventually led you to real estate.
Okay. I actually grew up in Jamaica, and not Jamaica
Okay.
Queens in New York, but Jamaica, the island.
Okay.
So I grew up in a rural area in St. Anne, actually, on the North Coast. And really from a humble background there, right? And grew up with a big family and, parents and grandparents. And really got the bug for entrepreneurship just by helping my grandmother with her business as a small farmer. So she grew things locally and she sold them at the local farm. So that's where I really honed in on, learning some of the skills as it relates to entrepreneurship. And I like to tell folks that that's actually where I learned how to read a scale. I know with these younger generation, they might be wondering what the heck is a scale. But
Right.
that's where I learned how to read a scale, how to make change, doing the math from my head, things like that. And so from there, even in high school, I had my own little, I know like for folks here in the US, they'll have like a lemonade stand or things like that. But I had a fruits that I was selling at school as part of my little entrepreneurial journey starting out. So that's actually been my background. And then I migrated here to the US just after high school finished. So when I migrated here, I went straight into college. And I knew I wanted to do business. And so I got into Bentley University, which is in Massachusetts, Waltham, Massachusetts. And that's where I studied computer information systems, which is a blend between technology and business. And so that's what I studied there, and then started my career in life insurance, doing project management work, and then moving into investments and financial services sector after that.
Okay. That's
How
quite a
real
journey.
estate, yes. How real estate kind of meshed into that, Keith, is really just always wanted to have my own business. So even though I had a 9 to 5, just always thinking about what I could do for myself. And so actually real estate came about by watching a infomercial late at night. I don't even know if those are still on, but just to date myself a little bit. And so from watching that
Yeah.
infomercial, I got introduced to tax liens, and they were talking about owning homes for pennies on the dollars, and I got the DVDs at the time, and that's how I got started. And then I went into probate, which I didn't like too much. It was a little bit too emotional for me, dealing with individuals when they've lost someone. I didn't like that part of real estate. And so from that, actually switched into stock investments. So I've moved around a little bit, and then I went into like real estate, REOs, foreclosures, and then landed up into mortgage notes, which I really liked because I didn't have to necessarily talk to the homeowner. And, you know, I know they
Hmm.
say in this business, it's really important to be able to make sales, right? By talking. But I like the fact that I could still make money in real estate and not necessarily have to deal with the homeowner or deal with the end buyer. So for mortgage note, it's really about the paper, right? So you are in the position of the bank, and the payments are coming to you as if it would with a traditional bank. And so I did that for a couple of years. Started that in 2015, and then when COVID hit, I was looking for another stream of income, like most people were. And so I got reintroduced, I should say, to tax liens, and I have been focused primarily on tax liens and tax deeds since COVID, but have been exposed to it prior to, and even with mortgage notes. Tax liens is one of the things I would have to check as part of my due diligence to make sure that my first position is still intact as a mortgage lien holder. So that's what I've been focusing on for the past few years. It's primarily tax liens, tax deeds.
Okay. Yeah, that's quite a journey. And it's interesting to kind of go from the degree in computer information systems into real estate, but I guess it makes sense kind of the way that you laid it out. And I'm sure that probably helps too with just the background and being able to look a lot of that stuff up and just understanding it. So tell me a little bit maybe about the notes. And then we can certainly, I really have an interest in the tax liens as well, but I'm just curious on the notes. How do you find those? What are some of the things that you like about them? I hear what you're saying as far as not having to personally, interact necessarily with, with the homeowner.
Mhm.
I noticed that with probates as well. We, in fact, we worked those as well there for a stretch of time. And, there is some emotion involved with it.
Right.
We've also done foreclosures and pre-foreclosures and,
Okay.
same thing. There's, either way,
There's
you're dealing with
synergy.
somebody that's under quite a bit of stress. So,
Yeah. So for the notes, how do you find them? So there is a secondary market for mortgage notes. So what happens is, let's say, for instance, let's use Bank of America just for the example, right? So you'll have, say, Bank of America, and they have thousands and thousands and thousands of mortgages. Some of them are performing, meaning that the homeowner is paying on them monthly in a timely manner, and some of them are non-performing, meaning that the homeowner is not paying; they are behind. So in both cases, Bank of America might bundle hundreds of those together, and they will sell them to, say, for instance, a hedge fund. Now, as you can imagine, you'll need millions of dollars to be able to purchase those from Bank of America, right? But the hedge fund will then now sell those again on the secondary market to say like a boutique or a trading desk, and then from there I might be able to purchase it from that trading desk, from the relationship that I have with them. So there is a secondary market out there for mortgage notes where you could buy. There's also other folks who have websites that you could go on to purchase it directly from the website. But like I always say, you want to know the persons who are behind those systems, right? To know what you're getting yourself into and what you're buying. But it's definitely a community that's out there that offers mortgage notes where you're able to locate those. In terms of what I like about mortgage notes in comparison to some of the other strategies that I've done in the past, I like the fact that I might be doing the same amount of work but making a lot more in terms of returns. And I also like the fact that, like I said, not that I don't like interacting with individuals, but it's like I said, everyone has their niche and their things that they like. I just didn't like the emotional part of the probate. And so with the mortgage notes, it's more about contracts and reading contracts and going through the paperwork and then crunching the numbers. And if those make sense to you, then, you move forward with the deal. So that aspect I like, the fact that it's just, for me, it's just reading contracts, paperwork, and doing the math.
Okay. And I like the way that you kind of laid that out with the example of Bank of America and the fact that they do sell off bundles of loans. And then on the second, they can sell them to boutiques, you said.
And people don't realize this,
then,
Keith. Like, really, Bank of America is in the business of, making money. It's not really, they're not into real estate, right? Their primary business is not real estate, right? So it's all about making money on those loans. So a lot of folks don't realize that not just Bank of America, but all the banks do this. And as a homeowner, maybe yourself or someone who's listening have actually experienced this, where you have a loan with a mortgage with a particular bank, and then a year go by, or even months go by. They don't even have to wait a year. Months go by, you get a letter saying, your mortgage has been sold to XYZ company. Please make your payments now to XYZ company. So that's actually what that looks like for a homeowner on the other side.
Yeah, that's exactly right. Yeah, for years and years, I was a full-time real estate broker, and I can remember almost, the majority of the closings that you go to, if there's a loan involved, that's one of the pieces of paperwork they're signing is saying, hey, your loan is going to be sold off. Pretty much they sell 99% or 98% or whatever it may be of those loans. So, but then they, like you said, they bundle them up and they'll sell them off in pretty big pieces that, it's a little difficult for an individual investor to get involved with it from that standpoint, unless you're, playing at that level. But you've said that you can, in fact, buy. So were you buying individual ones, or were they groups of them?
So
together?
So I've done both. I've purchased individual ones as well as groups of them. There are mortgage notes summits, if for lack of a better word, if you want to call it that you can attend, where you will meet folks who are actually offering these. If you have relationship with hedge funds, right, then you can also purchase it from hedge funds as well. But yeah, it's, depending on who you're dealing with, you may have the ability to buy a few of them together, or you might just be able to purchase one, right? For someone who's just starting out, it's probably more advisable to purchase one after you've gotten the right education, and then go through that process to see what that is like before, doing a bunch of them together. But yeah, the opportunity is there to do either or.
And you mentioned both performing and non-performing. And I've got a friend of mine that does non-performing, but I always like to just ask from your perspective, why would somebody take an investment in a non-performing note? Obviously for the audience, this is somebody who's behind on their mortgage. It is backed with real estate. So, there is that piece of security there, which I like about it. Exactly. But why would somebody do that as an investment? And which of those avenues, or have you done both?
I have done both. So why would someone do a non-performing or invest in non-performing mortgage note? Primarily because you get it at a deep discount, and then on the back end, you're still making good returns. So what happens is, like you've mentioned, the homeowner is behind on their loan. And I'm coming in and purchasing it from a hedge fund or a trading desk at a deep discount. The reason they give the deep discount is because the person is behind, and there's some work that I would need to do as a new investor to get that homeowner to start paying again and start being performing. And so because of the work that is required, that is why they offer it at a discount. Now, I'm willing, and other investors like myself are willing to get that work done. With the homeowner, sometimes it requires renegotiating the terms. Sometimes it requires trying to do a remodification, right? So we try to work with the homeowner to get them performing again. And worst case scenario, if that can't be done, then unfortunately, in some cases, we have to foreclose on the property like a regular bank would. But in all cases, we definitely try to work with the homeowner, because that's the whole purpose, right? To get them performing. And so to the short answer to your question is, we buy the non-performing because we get it at a deeper discount, but we also still make a good profit at the end of that.
Okay. And then is there an opportunity once you've gotten it performing again, say you've renegotiated with the homeowner. Maybe you've changed some of the terms, whatever it may be, but they continue to now they're paying on a regular basis. So now you're taking it from non-performing to performing.
Yep.
Exactly. You have the ability again at that point to maybe turn and sell it again on the secondary
And then at
market.
that point, to your point, Keith, it becomes a much more attractive loan for someone else if you wanted to sell it again. Correct.
Okay.
Yeah.
And
because at that point, there's not much for them to do. Sorry. Because at that point, there's not much for them to do. They're getting the payments monthly. So it's just hitting their account every month. They don't have to, work anything out with the homeowner at that point. It's just an autopilot, so to speak.
Okay.
So then that's why it's attractive.
And when you're looking at these, notes, first of all, what are some of the things that you're looking at to say, yeah, I'll take a chance with that particular one? Are you looking for a certain amount of equity? I'm sure that there's some kind of equity that you're looking for there. And then, payment history is,
yep. So you're hitting the nail on the head.
Okay.
You're hitting the nail on the head. So yes, definitely. So I'm looking for a certain equity. I'm also looking for their payment history. Like how long have they been stopped paying, right? What is the payment pattern been? Have there been years of not paying, or is it just months of not paying? Then they pay again, and then they fall off again. So we're trying to look at the payment history to guesstimate, what's happening in that situation. Obviously, you're not in a position to speak directly with the homeowner, but you look at the collateral file of everything that's happening over the course of that loan to help to determine whether or not it's something you want to get into. And then, like you said, I'm looking at the numbers, right? So I'm looking at the worst case scenario. If for some reason I cannot work it out with the homeowner, is this a property that I can take possession of and still make money on, right? What is the market like for that particular area that the property is in, right? So I'm looking at market analysis as well for that area, especially if it's an area that I'm not familiar with, right? And do I have a team in the area, or how quickly can I get a team up in the area? And when I say team, I'm talking about a realtor, I'm talking about a attorney, and I'm talking about someone who's local who can go look at the property for me if it's not something that's driving distance to me and I need to have eyes on the property. So those are some of the things that I'm actually taking into consideration as well.
Okay. And when you're looking at the note itself, obviously the current loan servicer or lender is going to have the payment history for that individual.
Correct.
Are you able to get any kind of additional glimpse into their overall credit worthiness as well? Or do you have to, in other words, I don't know if they're able, because they initially opened up a loan, they have a current loan with somebody, if they're able to continue to kind of look at their credit landscape and see, okay, they're defaulting on this, but it looks like they're defaulting on this, this, and this also. You may or may not have access to that. That's more of a curiosity thing for me.
I don't have access to that in the file that the servicing company has on the homeowner. Okay. So it's really making a decision on the paperwork that they submitted at the time of the initial loan application, as well as their payment history since they've signed that promissory note, to the bank. Are they making good on that, and what that pattern is like? And then really coupling that with the equity on the property, and then the numbers, really just crunching, basically looking at I have a budget analysis spreadsheet where I have different scenarios that I put numbers to. So if I had to sell it back as is, what would that look like? If I had to fix it up and rent it out, what would the cash flow look like? So I'm running different scenarios just to be sure that if any of those that I have to execute at any point, that I'm still making money and I'm still comfortable with what that return looks like. So it really comes down to the numbers.
Yeah, you bring up a really good point there. There's so many different avenues. If you've already got an existing loan in place, there's a good amount of equity already built into the deal. Yeah, sure, that the loan that you're purchasing, at a discount may end up defaulting, but you do have that ability to just put a renter in it. obviously you're going to have to anticipate that there may be some repairs and stuff that need to be done before putting somebody in there. But there's so many different exit strategies. There's also selling it, because it's already, you're just looking to recoup, some additional on top of what you've paid for it. So there's a lot of different exit strategies for this. It sounds like.
Correct. And that is also a good thing as well. And it's not just in notes, the same thing in tax liens and tax deeds as well. The ability to have different exit strategies. But even though there's multiple exit strategies, I always go in with one that I want in mind, but still have in the back of my head, okay, if this doesn't work out, I have B and C. But I go in with one exit strategy in mind, and that's how I approach the deal with with that exit strategy, and that's how I negotiate, with that exit strategy in mind. But yeah, you're certainly right. There's several exit strategies that you could execute depending on what happens. Because, life happens. You might think the homeowner, you'll work it out with them, and you may renegotiate with them, and they started paying, and everything is fine. And all of a sudden, life happens, and they fall off again. So, you always want to have multiple strategies available to you.
For sure. And what are maybe some examples that you've done in the past when you have been able to work something out with some of these folks? Like what are some changes what are some ways that you can get them back current? Assuming that they're maybe just not able to make up the difference on whatever it is they owe, or maybe they are. Or do you forgive what they've got behind to get them back current? Where you're saying, hey, moving forward, if we do this, can you continue to make the same payment, or do you adjust the rate down, or maybe increase the number of
months, the length? So most times it's the payment, the monthly payment is a problem for them. And in my cases, most times they're falling behind because of, things have happened, loss of work or health issues, right? So most times it's a payment, the monthly payment amount, that's an issue. So I try to make that payment manageable for them, basically, right? And so in doing so, sometimes it means that what they've already owed, we tack it on to the back, right? So, you don't have to pay it now, but, years down the line, then it would have to be paid, right? I haven't had a situation, or I should say, I am in a position to forgive the what they've owed, but in most cases, I just tack it on to the back, and most times they're comfortable with that. Most times, people are not just looking to live for free. It's just really that they fell on hard times and they need help, right? So for me, it's just more about making sure that they can manage the monthly payments, and if we have to extend the length of payments to make it more affordable, then I do that as well. But that's been my experience.
Okay. No, that makes a lot of sense. That's interesting. And have you purchased also performing notes, and as in addition to non-performing, or do you typically focus on the non-performing?
I do both, but I tend to do more non-performing, only because I seem to have better returns with the non-performing, because I'm getting it at a deep discount, and I don't mind doing the work to, get them performing again. But I do have a blend. I've done blend, both performing and non-performing in the past.
Okay. And when you say deep discount, so I guess tell me a little bit about, maybe give me, if you could, some examples of, how much of a discount are you getting on these, and and then how long does it generally take maybe to turn it around from a non-performing to a performing note?
Okay, great question. So in terms of a discount, so let's say I usually make my offer based on the amount that's still owing on the mortgage note. And I know a couple of investors do different things, right? So the amount that is still owing, we call that the unpaid balance. So I make my offer based on the unpaid balance of that particular loan. Um, Sometimes I get 45%, sometimes I get 65% off of that. So it all depends on how long they've been non-performing. It also depends on the amount of equity that's still in the property, and also the market, right, where the property is located. So there's a different few factors, and also if I'm buying one versus I'm buying 5 at a time or 10 at a time, right? So it might be able to get a better discount that way, and also it's a relationship that I have with the trading desk as well. So it could range from 45 to 65% of the unpaid balance.
Okay. Yeah, that seems like a great discount. And then as far as getting them performing again, I guess they're all going to be a little bit different. But is that
Yeah,
something that you could typically do pretty quick?
I would say, I'm trying to think what was the quickest one. I would say by the time the deal is finished with the trading desk to when I take position and then reaching out to the homeowner, anywhere from 6 months to a year. It all depends on how quickly, they get paperwork back to you, um, things of that sort. I would say anywhere from 6 months to a year, to get them performing again.
Okay.
Yeah.
And as far as just the industry standard, how many months in a row do they need to pay in order for it to be considered and marketed as now a performing note?
So I like to have at least 6 to 8 months of being on time after I've got them to reperform again. Um, Everyone's tolerance is different in terms of if you're looking to sell that to another investor might say, "Oh no, they're just been paying for the last 3 months. I need to see a longer history." So for me to be a little bit more on the safer side, I like to have 6 to 8 months of them being consistent with performing again before um, I look to say, sell that to another investor if that's something that I'm looking to do. But there's really no industry standard per se. It really is up to the investor that you're working with, if whether or not they're willing to accept that. And like I said, it depends on the history prior to that. What was that like?
Okay. And another question I have on this, and then I think we can shift gears maybe to the tax liens, but
Uh-huh.
on these. So if I take a non-performing, I'm getting 45 to 65% discount. I get it performing by working with the homeowner. Let's say it's 8 months later, and I'm going to turn around and be able to sell it again. When somebody's buying a performing note, are they still going to be paying a discount off of the unpaid balance of some sort? It's just going to be much less of a discount, or are they going to be paying the full unpaid balance in order to purchase that note?
In most cases, they'll be paying close to the unpaid balance because at this point it's like a premium loan, right? There's nothing for them to work out. They just gotta sign a paper and the payments come to them, right? So most there'll be some discount, but it won't be a deep discount. It won't be a deep discount. In some cases also, sorry. In some cases also, depending on the property and the location, some investors are actually willing to pay premium for that as well. So
Okay.
it all depends. Yeah, but it won't be a great discount, no, because there's not much workout for them to do, or any workout at all for
Right.
them to do.
And they're essentially making their money anyway on the
Correct.
interest rate being
On the interest
charged.
rate.
So that they're not really after a discount when it comes to a performing note. So that makes sense. Okay, cool. Hey, it seems like a great strategy. It seems very interesting.
It is. It
You've
is.
definitely piqued my interest. So,
Good.
Well, all right. Well, why don't we shift gears maybe and talk a little bit about tax liens?
Okay.
And what do you look for in those? And maybe describe, if you could, the types of tax liens. Are these typically county tax liens, or what does that look like?
Okay. So they are typically county tax liens, and what it is when the homeowner doesn't pay their property taxes. And just for the sake of your listeners, maybe there's someone who's new to tax liens and tax deeds. The county, each county that you're in, or at least here in the U.S., the counties that you're in, they make a fiscal budget, um, based on the property taxes that they anticipate to collect. And so they use that money for local services, to keep the parks clean, for garbage, collection, for local services like police and firemen, things like that. So they use it for different local services. So when they don't collect that money, now they're at a shortfall, right? Because the homeowner doesn't pay that taxes, so now they're short. And so the county, what they do is, and this is also within their right, they put a lien on the property, and that's what's called a tax lien. And this now gives the opportunity for an investor like myself to come in and say, hey, I'm willing to make that payment for the back taxes that the homeowner owes. And in return for making that payment, the county offers me an interest rate return. So when the homeowner pays up the back taxes plus the interest, right, and the county administers all of this, I don't deal directly with the homeowner. I deal directly with the county. The county administers this. The homeowner pays up the back taxes plus the interest rate. So then, as a return for my investment, I get my initial investment back plus the interest rate return. Right? So that is what a tax lien is. And so you get a tax lien certificate in that instance. The difference between a tax lien and tax deed is that the tax deed, you're actually bidding on the actual property. So when you bid, you're actually getting a deed shortly after, right? With a tax lien, you're not getting a deed right away. You're getting a lien, and you now have the right, or you have the right to put a lien on that property. So if that property is to be sold, all those lien holders would have to be paid off before that property can be sold, right? And similarly with the mortgage notes, where it's backed by real estate, it's the same thing with the tax lien. It's backed by the actual house, the home. Okay. What do I like about? I think one of your questions you had was, what do I like about the tax liens? Similarly, there's not. You might see a trend where after I respond to this question, I don't necessarily have to talk to the homeowner. So, and that is just because these can be stressful times for folks, right? Everyone is going through. Everybody has story is different. There's, at least in my experience, I haven't come across anyone who just willingly don't want to pay their property taxes and have the county put a lien on their house or take possession and have the deed, right? So usually folks are going through something, and sometimes it's trauma, and sometimes it's loss of job, of income, family members, things like that. So just that emotional part of it, I don't like to deal with. So this is why I like as well the tax liens, because I don't have to directly speak with the homeowner. Of course, there is opportunities to still speak with the homeowner in terms of a tax lien, if that's a strategy you want to do, because you can approach them to see if they want to sell the property before it goes to auction. And some people do that, right? So there's still opportunity to talk to the homeowner and get a discounted property if that's what you want to do. But that's just not my strategy. So I prefer to go through the auction and just bid, for the lien in that way, or if it's a tax deed auction, I bid for the property in that way. So I like the fact that I don't have to speak directly with the homeowner. I like the fact that it's just about looking at the numbers, seeing if it makes sense to me, understanding that particular market, looking at the actual property to see if there's equity in it, and then just working out my different scenarios and working out the worst case scenario, right? And actually, the worst case scenario in a tax lien situation, Keith, is really a win-win in my mind, because if the homeowner pays up the back taxes plus interest, I get interest on my money. If the homeowner doesn't pay it up, then I potentially could get a property way below market value. And similarly to how we talk about the mortgage notes have several exit strategies, same way in the tax liens, you have several exit strategies if you were to become the deed holder for that property, right? So you could fix it up and sell it at market. You could fix it up and you could rent it. You could sell it as is to another investor who wants to, do the work if there's a lot of rehab that's required. You could fix it up, something that I do, fix it up and look for folks who not able to qualify for a traditional mortgage, but they want to get into a house, right? So there's several things that you could do as well in this space.
Okay.
So that's what I like.
And on the tax certificates that you had mentioned, so somebody, let's say they get behind on, they didn't pay their 2023 taxes,
Uh-huh.
and they have an opportunity to pay up to a certain point. And I don't know, maybe it has to go over a year, but let's say if they don't pay in January, don't pay in February, by whatever time frame, the county says, okay, we're going to put a lien against the property at this point. Then do they turn around right away and sell those liens pretty well right after they get them, since they've got that budget deficit that you'd mentioned?
Yeah, so they would have notified. You're right. They would have notified the homeowner, and after a certain period of time, each county is different. Some counties are a year, some counties is after 2 years of not paying. So once they have notified the homeowner and they've passed that time deadline of not paying, then yes, they will definitely put it schedule it for an upcoming tax sale. But even though it's scheduled for a tax sale auction, the homeowner still has time after that auction to still make good on that back taxes. And so that timing is what is called a redemption period. And within that time frame, within that redemption period, some counties it's a year, some counties it's 2 years, 3 years, depending on the state and the county. So even after the auction, they still have a time period where they can make good on the back taxes.
Okay. And what are your rights as let's say if you bought the property through that tax sale, but I assume you can't resell it again if it's within that time frame. So as an investor, what's the benefit to having it exactly? Yeah.
Okay. So in most cases, you can't do anything with it within that time frame. However, there's some counties that allows you to transfer that lien to someone else. So let's say, and goes back into some of the different strategies, right? But just let's say that the homeowner gets a year, and Keith says, I don't want to wait a year to realize my returns. Some counties allow you to transfer that lien to someone else. So you could sell that certificate to, say, me, another investor, for a fee, right? And I'm willing to wait the year. You get your money back up front, or quicker, I should say, than the year. And I'm okay waiting for the year. So that's a strategy you could take. Also, if the county doesn't allow you to do the transfer and you're waiting for the year, most times that return that you're getting is more than you will get, say, in a CD or stock market or everywhere else, right? And that return is guaranteed. So the benefit of doing it is you're getting guaranteed returns from the county for waiting for that time period, right? And like I said, the worst case scenario, which really isn't, in my mind, is still a win. If they still don't pay up within that time frame, now you have a home, right? You petition to get that done. You'll have a house that potentially worth way more than you paid for the taxes that you paid, right? So that's the upside.
Right. Makes sense. And what are some of the from as far as the interest and stuff that you're going to be earning during the time frame? I obviously they continue to accumulate fees the longer they haven't paid those taxes. So if you own the certificate on it, you're continuing to accumulate at least a portion of those. I don't know if the county still gets some of them. Maybe not if you now own it and then you're the one that's paid, the county.
So while you are the holder of that tax lien certificate, when the homeowner makes payment for the back taxes, they also have to pay the fees and they have to pay the interest. If it's a county where the time frame, the wait time, which is the redemption period, if that wait time is more than a year, then the county will give you, as the lien holder, the first right or the opportunity, I should say, to make the next year's payment, right? Sometimes, depending on the county, they're good about reaching out to you, but as an investor, you really should be paying attention and keeping track of, your investment. So you can they will contact you, or you can reach out to them to have that opportunity to make the payment on the second year, because you want to keep your investment, right? You want to make sure that you get that initial investment back plus the interest. So you could definitely do that. Sorry, I lost my train of thought. So
no problem. what kind of interest or
Returns, yes. Thank you.
what kind of interest rates are you receiving during that time? I know it's probably going to vary from county to county, but just
Yep. So you could definitely get interest rate from 8% all the way to 36%, depending on the county that you're investing in. And this is something that you could definitely find out, online in terms of what they offer. So if it's, say you've decided on a particular county, you could definitely check on their treasurer's website to see what they offer in terms of interest rate return. You could definitely call the office and they will certainly tell you as well if you can't find it online. But most times it's information that's there. But that's the gamut, right? From 8% to 36% return that you could get on your investment.
okay, no, that's huge. Okay,
Yes. And
so
then
it's
you could
okay if it
target.
takes a little bit of time.
It takes a little bit of time. There's counties that um they'll have wait time as little as 120 days all the way up to 3 years. So you could definitely target, the ones with a shorter wait time. And also you can target the ones with a higher interest rate. So it all depends on what you want and how long are you willing to wait for that return.
Yeah. Okay. And just for the audience to be clear as well, so if it does go to auction and you buy this within auction, even though it has that period of time, that wait period of time, um, once it has gone to that spot where it's gone to auction, they have been foreclosed on essentially, so they're no longer living in the property, right? When that happens, or are they living potentially in the property still while you're going through that wait period?
Yes, they are living in the property still. Um, Most times, well, sometimes it's vacant, sometimes it's occupied. But if it's a property that was occupied prior to the auction, most times they would still be living in the property, even after the auction during that wait time. Sometimes it's owner occupant, sometimes it's a rental. So those are things you will find out as part of your research, before you got to the auction to make sure that you know what you're bidding on. But if it's a situation where they they're still living in the property even after the auction and even after the redemption has ended, and you're now looking to take possession of the physical property, then in some instances the county will work with you and officials to get the individuals out of the property. In some instances, you have to do that on your own with an attorney. So it depends on the county in terms of their process. But most times it's occupied. But you could definitely target properties from the auction that are not occupied, that are vacant, because those exist as well. And just so as well, Keith, as I'm thinking about this, I'm answering the question. You also have properties on the auction that are not just residential. So you have commercial properties as well, and you have agricultural, and you have land, like different types of land, residential land. So those, if you're concerned about getting a property that's occupied and you don't want that, you could certainly look for properties that are vacant, or you could look for land if that's something that you want to do and looking to develop. Maybe that's one of your exit strategies. You want to develop residential properties on the land.
Yeah. Yeah. Okay. No, either way, all those sound like good opportunities. And then the only I guess, do you ever buy? So the only thing I'm thinking of is like, okay, so if you've got a home, if it's just like a single family home, that they've fallen behind, you've gone through the process, they're still living there maybe, or have a tenant there. Are you doing anything to ensure that the asset itself has insurance on it, or
Not while I
typically?
have the certificate. So after I've gotten possession of the deed, after I've gotten the deed, then
Yeah.
yes, I'm insuring that property. But while I am still a lien holder, right? While I still have the
Uh-huh.
certificate, I'm not putting in insurance on it at that point, because I'm really not technical owner, right? I have
Yeah.
rights to it, but I know I'm not on the deed at that point. Um, if but I get where you're going at. So you're pretty much trying to say, if say in the event that something happens to the property, what you know, what do I stand to lose or what do I stand to gain in that situation? Um, Even though, say, let's say there's a fire to the property, while you are holding the tax lien certificate, the taxes are still owed, right? So the homeowner will still have those taxes to pay to the county and the interest. As a homeowner, though, they would have had insurance on the property. I hope they would have, right? And even if
Right,
if there
right.
is a loan on it, they most likely, if there's a loan on it, the mortgage company would have required them to have that. So um, in that instance, they would have had insurance on it, and then would have had made a claim from the insurance company to do a rebuild or repairs or something like that. But in terms of the investment that you'll make, that those taxes wouldn't just get wiped out because of that situation that unfortunately would have happened. So they would have had to still make good on the property taxes that they owe.
Yeah, yeah, makes sense. Makes sense. And I really meant once you've got the deed, just I'm thinking if you have that hold period of, or that, redemption period of 12 months or whatever it may be, just to keep, if there's not a lien on it, you're getting it, as, almost at just the back tax value of it. Just, being able to put something on it to ensure that if there was, fire is kind of like the worst case scenario deal, but,
Right. So all right. So I'm glad you elaborated or clarified that a little bit for me. So now I understand
Mhm.
exactly what you're saying. So in the situation where you now have the deed or you purchased the deed, you're the homeowner shortly after. Like usually the county takes weeks for you to get, less than a month most times, for you to get the deed. So once you've got that deed, then yes, you definitely want to put insurance on it. Also, to touch on something that you said, which I didn't say prior to, um, yes, there's also counties that offer a tax deed sale and still gives the homeowner time to make good on the payment. So you don't get the deed within weeks. There's still a wait period. In those cases, it's called a redeemable deed. And
Mm.
I know I'm getting a little bit into the nuances, but just be mindful that yes, that also exists. And when you said that, it triggered. I get to understand better what you're saying. Um, Typically, when you buy the deed, you're getting the house within the deed to the house within weeks. There's also another scenario where you buy the deed, and it's called a redeemable deed, whereby there's an additional wait time where the homeowner still has time to make good. In that case, you can't put out insurance yet because there's still a wait time. So you'd have to wait until that period
Okay.
ends.
Okay.
I
Yeah,
hope I
makes
didn't
sense.
confuse anyone.
No, no. It's like I say, it's a very interesting strategy, and there's a lot of opportunity. I
Yes.
recently purchased property, and there were multiple tax liens. They ended up getting, there's obviously companies out there that will lend money to them as well, and they basically probably hold these
Mhm.
certificates as kind of collateral or
Collateral.
whatever.
Hmm.
But I can see where there's scenarios out there where, even like you said, even commercial property, where you have an ability to be able to have a opportunity to eventually purchase it on the dollar or purchase these certificates and just earn off of them. So that's
Correct.
awesome.
Correct.
Oh, this has been great. Natoyah, I really appreciate it. How can people find out more about you? And if they, I don't know if you help others invest as well. I know you're a member of various RIAs, and so just
Yes.
how can people find out more about you if they'd like to learn more about
Sure.
this
So
subject?
they can reach out to me through my website, apexglobalproperties.com. I'll give you the link and you could also put it in the notes. But I'm also teaching tax liens and tax deeds this November to folks who wants to get involved, right? So I'm being a part of a summit here in New York, November 8th through 10th, which is Veterans Weekend. And so folks can come and participate. My objective is to get more folks involved. It's not a strategy that is utilized by many, and the opportunity is just great, right? I can't buy all the tax liens and tax deeds by myself, to be honest. So I'm teaching the strategy. People are like, oh, you're teaching it? I'm like, yes. I mean, a lot more people need to get involved. The opportunities there, people are looking to invest, people are looking to make their money work for them. So I'm part of the Fiscally Fabulous Summit here in New York, and folks can come out if they're, want to learn more and deep dive. It's an implementation summit. So it's not just you get information, you go away. No, we're doing it while we're there at the summit. I'm helping you and walking you through from start to finish. And I'm also looking into making sure that there's, auctions that will be going on during that time so we can participate in that as well and get you involved and start, especially for entrepreneurs who are just starting out, the goal is to get you to your first 100K. And that's what I'm working on. There'll be other individuals as well and experts on the summit who will be talking about different parts of your business. Say you're looking to form an entity, you're not quite sure if you should do LLC, S Corp, C Corp, whatever it is. So there'll be someone there to talk about that. There'll be a CPA. There'll be someone that's there to talk about credit because that's also important if you're looking to do this as a business. So definitely check us out, gwfiveconference.com. And, reach out to me if you have additional questions. And I also have a special code as well, Keith, that I can also share with your community for folks who wants to get involved and take advantage of that. So that will be here in New York.
Okay. No, that's perfect. Sounds really good. We may have to talk offline on that too as well. So be interested.
No problem.
Sounds like something my wife would enjoy coming to as well. So, well, this has been really good. I appreciate it. We haven't had a whole lot of folks on our show, talking about, tax liens, tax lien certificates, tax deeds, and even notes. We really haven't had too many folks, and you really covered the gamut on all that stuff. So this has been awesome. I've got 2 more questions for you that I ask every guest. And so if you've got just another minute or two, I'd like to ask you those. Number 1 would just be, any advice you would give somebody who's just starting out in their investment journey?
I would say try to get good education, right? Foundation is good. Try to get good education. Align yourself with someone who's actually doing what you want to do, right? Not just someone who's teaching you from a textbook. I know there's a lot of information out there on the internet, on YouTube, university, things like that. But vet the people, do some research on them, ask other folks who have used, their services. But definitely education is key. My focus is really on helping folks implement what they learn because when I started out, Keith, I spent thousands and thousands and thousands on different programs and I didn't get the support, right? The education was always lacking. There was always another upsell. There was always something else. You never get the meat, right? So my goal is to really just give you everything and so you can be successful. So I would say align yourself with someone who's actually doing whatever the strategy is that you're looking to do, that they're physically doing it and learn from them and just soak everything in like a sponge. Yeah.
All right, great. I think that was great advice. How about a book recommendation? Doesn't have to be real estate related, but it certainly can be. Just something you've read recently that's been impactful.
That is actually a good question. But really, I've read one recently, but that was more about stock investment. But I think a good one in terms of real estate would be The Richest Man in Babylon. I'm not quite sure I don't remember who the author is, but in terms of mindset and getting into real estate and understanding diversification and just understanding money and how to do that, I would say that is a good read. And especially now, well, not just now, but for some time now, folks have been talking about generational wealth, different streams of income, so much so that it's almost like a buzzword. But really, if you're truly, truly practicing generational wealth, that is actually a good book to definitely get your hands on. It is a good read, and I've read it several times. It is a good read.
Yeah, for sure. I love that book. It's a really good one. So yeah, it's a great one. I can't remember offhand. Otherwise, I'd help you out with who the author was. But can't remember offhand. But it's a really good one. Great story too.
Yes,
so.
yes.
And has some really some things that everybody can kind of put into use, whether it be for saving money, donating to charity, all of the kind of different avenues to be able to grow your wealth.
I agree.
Sure.
I agree.
Well, this has been just amazing, Natoyah. I really appreciate it, and thank you so much.
Well. I enjoyed it.
Yeah.
It was good chatting with you.
Awesome. All right. Well, thanks so much for being on the Wealth Flow, and have a great weekend.
You too. Take care. Bye-bye.
All right. Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.